Well, good afternoon, everybody, and welcome to North of England Russian Sanctions Oil Price Cap seminar. It's good to see so many of you joining the call already, and I'm delighted to say that I'm joined today. I'm Mark Church, Director in the FD&D team, and I'm joined today by two of my colleagues who, if you've been to one of these webinars before, may well be familiar names and faces to you when it comes to Russian sanctions discussions. So firstly, you've got Mike Salthouse, who will be a familiar name to, I guess, almost everybody on the call probably, who is been doing a lot of work in this area over the last few years and over the last few weeks has been, as in his role as head of the IT Sanctions Committee, has been very, very heavily involved in discussions with the UK, EU and the US. And I'm also joined by David Richards, one of our directors in the claims departments. Before we get on to the substance of the talk, just a few housekeeping points to note. Please, if you have got any questions, and thank you for those that have already submitted their questions in advance, but if anything pops up as we're going through, please do just drop a message in the chat box and we'll do our best to deal with that question at the end. Please also mute your mic to reduce background noise. And finally, please also note that this session is being recorded. So if you do have colleagues that weren't able to make it today, then we will be distributing the talk after the session has ended. I think as a provisional comment, when we planned this webinar 2 or 3 weeks ago, we were hoping that we would have a little bit more of a run-in before the talk and after publication of the EU, UK and US legislation. As it's turned out, we've had about 24 hours, so apologies if there are questions that we're running through that we can't answer today, because the conversations with the regulators and with industry will obviously continue in the coming weeks. The way that we're going to just divide up the session today, Mike is going to start by just running through some of the big picture issues, where we are now, the goals of the price cap. I'm then going to turn to a little bit of the detail on the UK, US and EU legislation. And then David's going to pick up an issue at the end, which I'm sure is something that many of you will be aware of, which is the Turkish request for confirmation of P&I cover, which is linked to the developments in Russia. So without further ado, I'm going to hand over to Mike now, who's going to run through the basics of the price cap. Mike, over to you.
Thanks, Mark. We could just have the first slide, please. Okay, so the Russian oil price cap. What I'm going to do over the next few minutes is explain what it is, how we think it's going to work, and also where it's actually got to. The basis of the oil price cap really lies with the EU 6 sanctions package, which was published back in the 4th of June. And at that point, what happened was that the European Union banned the import of Russian oil into the European Union with effect from 4th of June, although there was a wind down period to the 5th of December for crude and also to the 5th of February for petroleum products. But they also banned the provision of services for vessels carrying oil out from Russia outside the Union with effect from, in practice, the 5th of December and the 5th of February. That caused some concern, particularly back in the United States, because it was widely perceived that the ban on EU services would severely constrain the export of Russian oil. And Russia, as you may know, is the world's, I think it's the second largest producer of crude oil in the world. So that was going to constrain supply, and that would have an effect on price. The sorts of figures that were being bandied around, if you think that in March 2020, just before COVID, the price of oil was down to about $30 a barrel. Barclays were forecasting that if the services ban was maintained, it would reach as high as $200 per barrel after the 5th of December. So we get to this picture here, which was the G7 summit hosted by Germany in Elmau on the 2nd of September. where the price cap was announced. And the price cap has three objectives. It is to keep oil flowing onto world markets. It's also to ensure that there is a stable price and that the price doesn't go up to the sort of $200 a barrel that Barclays were forecasting. But it is also at the same time designed to reduce Russian oil revenues. Next slide, please. So what is the Russian oil price cap? Well, it's $60 for crude, and we will find out what the price is for petroleum later on when we get towards the 5th of February date. It applies from the point at which it's loaded on a ship for export to a third country to the point at which that cargo has cleared customs at the point of destination. If you take it into another country's territorial waters, ship to ship, and then take it on to another country, the price cap will continue to apply if it has not cleared customs. Once it's through customs, it may be freely traded, and there's obviously the opportunity, depending on where the price is set, to make a profit once the cargo has gone to its third country and cleared customs. How does it differ from previous sanctions? Well, I think there's a number of significant differences. First of all, there are three jurisdictions involved in equal measure in a coordinated sanctions program. It is highly coordinated, but they are still three separate jurisdictions. And that means that whilst, as far as possible, the price cap scheme is the same between the three, and we're talking about the United States, the United Kingdom, and the European Union, each has had to introduce slightly different laws to reflect their own legal jurisdiction, and there are slight differences between the three. The second point is that this is neither a cargo nor a country ban in the way that we've seen sanctions program in the past. If we go back to the sort of basis of modern sanctions, which was the CISADA ban on the import of refined petroleum products into Iran in 2010, that was a specific product going to a specific country. Here, there is nothing unlawful about taking a specific product from a particular country, in this case Russia, but what is prohibited is carrying it where it's been sold above the price cap, above the $60 in the case of crude. How is it going to be enforced? Well, it's going to be enforced by you and us. Because none of those three jurisdictions is likely to have jurisdiction over the buyer and the seller of the cargo, instead, enforcement relies on a system of written checks, so-called attestations, that the cargo has been sold below the cap. The extent of the checks that each of us is meant to complete will depend on which tier we fall into. You will see from the guidelines that have been published that parties involved in the export of Russian oil are categorized into three tiers, with T3 being the parties like ship owners and insurers who are most removed from the point of sale, and Tier 1 being those people who have either direct knowledge or can obtain actual knowledge of the price at which the cargo is sold. And it's up to the Tier 1 party to ensure that the cargo has been sold below price cap, and then on request to provide a written statement that the cargo conforms to the price cap to anybody that asks him, most possibly the Tier 2, who might be a charterer, and then on to the ship owner, who might be a Tier 3. The risks at this stage, I would say, they are largely operational rather than legal. Why do I say that? Well, because the states that are implementing the price cap legislation very much want Russian oil to continue to flow if it's to maintain stability in world oil prices. Therefore, the legal environment which we're offering is relatively light touch. Operationally, however, it's a very different question. There are so many points of failure in this scheme that the likelihoods of delay and the practical problems that we're currently seeing in the Turkish Straits are very high. And that will be the theme of this talk as we continue through it. Next slide, please. So if we look at the three jurisdictions, we start with the European Union. The relevant regulation is Regulation 833/2014, and it was most recently amended to give effect to the price cap on the 3rd of December. On the 3rd of December, the services ban that apply to businesses like the P&I clubs from providing P&I insurance to vessels carrying oil from Russia to a third country after the 5th of December, in the case of crude, was removed, provided that the cargo is below the price cap, below the $60 price. Simultaneously, a carriage ban was introduced. So up until the 5th of December, an EU ship owner could carry oil wherever it wanted to, as long as it wasn't into the European Union, and it didn't have to worry about the price paid. Now it can only carry that cargo if it is below the price cap. Recognizing that some European Union vessels will be on the water with non-price cap compliant cargo, there's a 45-day transitional arrangement so that if you have Russian cargo that has been sold above $60, you have until the 19th of January to discharge that at its port of destination. And that transitional period is replicated across all three jurisdictions, UK and US. We can't look at European law without giving some attention to the frequently asked questions, or consolidated frequently asked questions, the most recent version of which was published on the 3rd of December. We have to pay considerable attention to this because of the system of law practiced within the European Union, which is largely a civil law system, and that adopts a purposive approach to interpretation. That means that when construing the legislation, lawyers and judges are entitled to look at what the intent of the legislation was, not just what it says. And the FAQs represent the best evidence of what the intent of the legislation was. Now, unfortunately, what we've seen is that that has been used in the past sanctions programs to change the meaning of the law really as the sanction situation evolves. And the most obvious example of that was with coal. Where the wind down period for the carriage or the importation of coal into the European Union was the 10th of August. And it was understood from a literal reading of the relevant regulation that EU ship owners and EU insurers would be able to continue to insure the carriage of coal post 10th of August, providing it wasn't going to a jurisdiction within the European Union. As late as the 9th of August, the European Union issued new FAQs saying that there would be no EU carriage or insurance to third countries for coal fertilizer after the 10th of August. That caused a lot of disruption, with insurance being cancelled on vessels that were mid-voyage and European ship owners finding that they were actually performing an unlawful trade if you read the FAQ, if you consider the FAQs to be evidence of the intent of the legislation. No doubt that created some consternation within the European Union, and on the 19th of September the position was reversed again, because coal and fertilizer were then deemed to be humanitarian cargoes, and the carriage and insurance of all humanitarian Russian cargoes is lawful. Now, I refer to coal, which was a very unhappy example, simply because the risks of this reinterpretation of the price cap continue for as long as we have to rely on the use of FAQs to understand what is intended by the EU price cap ban. Next slide, please. The position of the UK law is based on the Russia Sanctions EU Exit Regulations, number 16, the 16th Amendment, which was published on the 1st of November. It introduced a carriage and insurance ban in line with the 6th sanctions package, coming into effect on the 5th of December. We then had a general trade license published on the 4th of December, which allowed ship owners subject to UK jurisdiction and insurers, banks and flag which is subject to UK jurisdiction to offer their services for Russian oil cargoes to third countries, provided it was below the price cap after the commencement date of the 5th of December. Next slide, please. Now, somewhat unusually, the UK had preempted their general trade license with a guidance, which they first published on the 2nd of November, and they've now updated it considerably. It's a different document, and I would recommend, if you read the 2nd of November one, that you also now need to read the 4th of December version. But the basic principles probably remain the same. So the first thing I would say about the UK guidance, which doesn't have the same legislative effect as the EU FAQs, because the UK gives precedence to the wording of the legislation, not the intent of the legislation, but is still nonetheless of relevance when considering how the UK authorities will approach the price cap. First point I'd like to make is the safe harbour provision, which is most evident in the US legislation, which we'll come to in a moment, has been watered down. The idea of a safe harbour means that provided you got an attestation and you did some general due diligence, you would be afforded protection from prosecution, even if the attestation turned out to be invalid at some later date. The UK doesn't approach it quite like that. Instead, it says you must do customary due diligence and you must get an attestation. And provided you've done that, we will take that into consideration when deciding whether or not to prosecute if subsequently it's found that the cargo had been sold above price cap. So it's not such a secure safe harbour as that afforded by the US guidance, which we'll come to in a moment. The other issue that's a little bit frustrating is the issue of pariah ships. What do I mean by a pariah ship? Well, as far back as September, the international group was pointing out to the US, the UK, and the European Union that there was a real risk of vessels conducting proper due diligence, getting what appeared to be an attestation, and then finding out that either the cargo had been sold on board the vessel at a price above price cap, or that the attestation was false. In those circumstances, we would be obliged to terminate cover, banks would be obliged to withdraw their services, and so on. And it's quite likely also that the trade in which the vessel was involved would not be capable of being completed. The port wouldn't allow an uninsured vessel to berth. The buyer of the cargo above price cap may well not wish to take delivery. So that may leave vessels afloat without insurance for some considerable time whilst a practical resolution to the problem is found out. This hasn't been addressed by any of the guidances, and it's one of the big practical problems that we see with price cap that owners are going to have to factor into any decision as to whether or not to carry price cap cargoes. The other issue or feature of the UK guidance relates to reporting. In the past, if a P&I club or a bank or whoever had concerns about a vessel that may either deliberately or inadvertently end up breaking sanctions, it would investigate the matter and, if appropriate, terminate its services. Under UK law now, there is a positive obligation to report a reasonable suspicion of sanctions breaking activity. So that means it's not just a case of the club terminating cover, it must report to the government, and a failure to do so amounts to a criminal offence. Which brings us to the enforcement under the UK law. There are fines, both civil and criminal, and the fines can be quite significant, up to 50% of the transaction value, and individuals can also face custodial sentences. Next slide, please. Turning to the US, this has always been a US scheme. It was initially the brainchild of Janet Yellen, and the US deserve compliments for the way in which they've engaged with industry throughout this process. Their guidance and legislation is perhaps the easiest of all three schemes to understand, and it was also the first to be published. So back in the 22nd of November, they issued a termination under Executive Order 14071, and that allowed US parties to carry and insure Russian oil after the 5th of December, provided it complied with the price cap. At the same date, they issued a final guidance. This relates only to crude oil. They'll issue additional guidance relating to petroleum, presumably when we get closer to the 5th of February date. And they also issued a general license number 57, which provides that businesses such as P&I clubs and banks can respond to emergency situations which present a threat to the environment or threat to life, even though the cargo is above price cap. And that General License 57 and its exception for dealing with emergencies is actually replicated both in the EU regulation and also the UK amendment to the Russia Sanctions Act. So in all three cases, there is scope for P&I clubs to respond to emergencies, even though the cargo that's being carried is above price cap. Next slide, please. So a very rapid run through what's happened over the last few days, but I thought I'd end really with just a summary of what I see the risks of this are. As I said at the outset, the risks of participating in the price cap scheme are probably not legal ones. All of the US, the UK and the EU want ship owners and want clubs to carry and insure these cargoes, because only in that way does the price of oil remain stable and the impact on the world economy mitigated. However, there are a number of difficulties here. One of the first difficulties I would say is that that states aren't really sure what they mean by customary due diligence. In the initial drafts of the guidelines that have been published, there was reference, for example, to the May 2020 advisory, an OFAC document, and a suggestion that parties should be monitoring the AIS of vessels that are involved in these trades, avoiding STS shipments, and so on. But that compliance recommendations were really focused on a different threat, where it was about the origin of the cargo and the nature of the cargo. Here we're actually looking, we know we're carrying Russian oil cargo, we know we're carrying it from Russia, but what do we mean by customary due diligence in the context of trying to understand what the price has been paid for that cargo when ship owners and insurers have no direct access to the price? Secondly, the attestation, there's a number of draft attestations published within the guidelines, but it's important to understand that these attestations are guidance only, and an attestation varies depending upon what situation it's intending to address. So the draft attestations will not be appropriate for all circumstances, and you shouldn't be too heavily bound by the drafts that have been provided. Evasion, I would say only on this is that early estimates were that up to 40% of cargoes would be non-compliant with the price cap. Now that percentage may have reduced because the initial level of the price cap at $60 per barrel has been set so high. But certainly if the price cap reduces, as I suspect it will, then we may see more widespread non-compliance. I think the point is that percentages of 40% mean that this is very much a feature of Russian oil cargoes. It means that 4 out of 10 cargoes that you're being asked to carry probably don't comply. We still have the issue of non-compliant cargo on board. You could do all the due diligence in the world, you could get an attestation which appears to be valid, but if it turns out that that attestation is false and or the cargo is sold whilst it's on board your vessel at a price above price cap, then you will lose access to your EU G7 banks, you will lose access to your EU G7 flag, and you will lose access to your EU G7 insurance and reinsurance. And potentially, probably even, you won't be able to deliver the cargo to the intended destination. And that will mean that your vessel will remain afloat, uninsured, with no access to banks for some considerable period of time. Finally, secondary sanctions. Well, we'll all be relieved to see that there are currently no secondary sanctions, but that's really because the US doesn't deem them necessary. Enforcement will take place by the UK, by the European Union, and in respect of its own nationals, by the US. They haven't taken them off the table. They may come in at some future date, but I would ask you to note that the impact of these measures are nonetheless extraterritorial, particularly those of the European Union and the UK. Services, banking, financial, provided by the European Union and the UK are not available, even where it might be, for example, an Indian ship owner carrying a cargo perfectly lawfully under Indian law from Russia to India if it's been sold at a price above price cap. And to that extent, there are secondary effects of the price cap legislation. So that is all I intend to say. I'm now going to hand over to Mark, who's going to have a look at a bit more of the detail. Thank you.
Yeah, thank you very much, Mike. So I just wanted to take 5 or 10 minutes just trying to put things a little bit more in context and going through the detail of the measures that Mike has been discussing. So what we've tried to do in the time that we've had is just do a side-by-side comparison of the position as per the UK, EU and US. As Mike was mentioning, this is really unprecedented coordinated action by the UK, EU, US, and I think they've generally done quite a good job of making sure that there aren't any huge differences between the varying legislation that's been introduced. However, there are some key differences, as we will go on to discuss in the next few minutes. But just taking a step back and reminding ourselves what has actually been introduced here. And it's one of the questions that we have been asked a few times is, okay, how does the price cap relate to transport into the EU? As Mike mentioned, this is a transport ban to third countries. So the UK has introduced a ban on transport of Russian oil, CN code 270900 from 5th of December, and petroleum products from 5th of February. Likewise, the EU, it's now banned to transport crude oil with the same CN code and petroleum products from 5th of February 2023, crude oil from the 5th of December 2022, which originated in Russia or which have been exported from Russia. And there's a similar ban in the US. Now, the UK have introduced a ban on import into the UK. The EU, there was already a ban on transport with some limited exceptions, which has been in place since June. So really, we are, of course, talking here about cargoes being lifted from Russia or of Russian origin going to third countries. And along with the transport ban, you'll be, of course, aware that there is an insurance ban as well, which has been put in place by UK, EU, and US because of the fact that there aren't really US secondary sanctions. We are, of course, most focused on the UK and the EU position. And on the EU position, there's already an insurance ban in place for us, for cargoes going from Russia to third countries, which was subject to a wind down period until 5th of December and 5th of February for petroleum products. So up until the 5th of December, whilst the transport wasn't banned because that's the new restriction which has come in, the insurance was banned subject to a wind down period, which has now expired. On the EU side, there's also this provision which caused quite a lot of concern in the run-up to the price cap legislation being introduced, which was Article 3N7, which dealt with the impact of a vessel intentionally carrying Russian oil above the price cap. There was some in the original draft of that article, there was some concern that basically if you had a ship which was carrying oil above the price cap, intentionally or not, then they would be blocked out from ever being able to obtain insurance from within the EU and indeed financing and servicing. If you look at the latest amendments to the EU regulation, Article 3N7 has now changed. It's been amended so that it relates to the intentional carriage of Russian oil above the price cap, and then we would be prohibited from providing cover for 90 days after the cargo purchased above the price cap has been unloaded. So it's no longer a indefinite period after which you can get P&I cover again. Moving on to some of the other features of the price cap, one of the questions that's been raised quite frequently already is, what about oil which was loaded before the 5th of December? And generally, the UK and the EU and the US are in the same position, which is that transport is permitted and insurance is permitted until January the 19th, 2023, when that Russian oil was on board before the 5th of December. So if you've got oil on board now that was loaded before the 5th, you don't need to worry about the price cap so long as that oil is off by the 19th of January 2023. And there's one key difference on the UK in the UK legislation here, which is that the wind down general license, which was published, which allows us to provide cover until the 19th of January 2023, does require us as a tier 3 provider, does provide us to obtain an attestation, not that the oil is below the price cap, but that the oil was loaded before the 5th of December and will be offloaded by the 19th of January. So that's a specific additional UK requirement in relation to oil which is on board as of today. I also believe the UK and US are silent about what happens, and we mentioned David will come on to talk about the issues that we're seeing in Turkey at the moment. But the UK and US, I don't believe, directly address the position. What happens if, through no fault of your own, the ship is delayed and the oil isn't off by the 19th of January? The EU do say that in the case of proven force majeure hindering the unloading at the final point of destination prior to 19th of January, the wind down period could be extended beyond 45 days until the hindering circumstance has ceased to exist. A note of caution there, and it may be that we get more guidance on that as we head towards 19th of January. But at the moment, it seems to me to be pretty unclear what you would have to do to fall within that force majeure exemption. And as I say, I'm not convinced it's necessarily mirrored by the UK position. So, as you'll all be aware, yes, there is a price cap exemption. So after 5th of December, you can still carry Russian oil to third countries, but you have to ensure that it is below the price cap. And the UK, EU and US provisions are all pretty similar in this regard. The UK has issued a general license allowing the carriage of oil below the price cap, and the EU have amended Regulation 833, introducing Article 3N6, which provides the transport ban will not apply when the goods are carried under the price cap. And generally as well, at what point does the price cap apply until? Generally, there's the explanation is pretty similar. So the EU says the price cap will no longer apply after the crude oil has been released for free circulation in a jurisdiction outside Russia and consigned to the landed purchaser. If the oil has been customs cleared and then becomes seaborne again without being substantially transformed into a different goods in line with non-preferential rules of origin, i.e. without being refined, then the price cap will still apply. One thing I didn't mention, which I probably should have earlier, is that the price cap does, and I know this is a question that's been asked, the price cap does include SDS operations as well. So it's Russian origin cargo and cargo lifted from Russia. The EU also have a comment in their FAQs about what happens to trading above the price cap during transit, and the FAQs say that ship owners are not required to obtain further attestation from subsequent buyers of the cargo during the transit. Again, I'm not sure that that's something that the UK and US directly have addressed or addressed in the same way as the EU, at least. There are also some further exemptions to the ban. So there are some very narrow circumstances where you can carry oil above the price cap. Oil from the Caspian Pipeline Consortium is one such exemption, where that is Kazakh oil just going through Russia by pipeline, and the EU and UK both directly address Kazakh oil coming through the CPC. The Sakhalin 2 project is a exempt project. So again, if you're carrying oil destined for Japan from Sakhalin 2, then there's a general license allowing you under the UK to carry that cargo, and the EU and the US make it clear that that is also exempt. There's a general license 55 on the US side, which provides you the ability to carry oil above the price cap if it's from that project. Finally, and a question I know we've been asked about bunkering. The EU have addressed this in their FAQs. The question is bunkering of Russian oil included? And the answer is no. The maritime services ban does not extend to bunkering, service of supplying fuel for use by ships. I haven't seen it suggested anywhere that bunkers are included in the ban, but again, a slight note of caution in that the way that the EU FAQs are drafted, it's unclear to me at least whether it's answering the question as to whether you could supply bunkers to a vessel carrying Russian oil above the price cap, or whether the supply of bunkers falls outside the price cap. As I say, I haven't seen it suggested that bunkers are subject to the price cap. And I guess as on an ordinary meaning, the question is bunkering of Russian oil included? And then the first word response to that is no. But I know that's a topic which is of some concern to people, and it may be that we get further guidance on bunkering in the coming days. Then finally, just turning to attestations. Again, the UK, EU, and the US are clear that all parties require attestations. It does depend where you fit in, whether you're tier 1, tier 2, tier 3, as to what exactly you need to do. Tier 1 persons are those with direct access to the price, for example, importers, commodity brokers, commodity traders. Tier 2 persons are those that enter a transaction with a tier 1 company but don't have access to the price information. So that might be financial institutions providing trade finance, shipping companies chartering a vessel from one third country to another. And there are slight differences. You'll see the UK section's a little bit fuller here than the EU and the US. What most of the people on the call, and indeed ourselves, would be concerned with is what tier 3 persons have to do, because they are defined as to include insurance brokers, cargo insurance, P&I clubs, reinsurers, and indeed ship owners. So these will be tier 3 persons will usually have no access to the price information, and we are required to ensure our counterparties have committed not to purchase Russian oil or oil products above the price cap, and this can be done through a provision of a signed attestation or inclusion of an attestation in contractual obligations. And there'll be more, I think. I know the IG is looking at exactly what we may require as a P&I club. In order to ensure that we comply with both the UK and the EU requirements as to attestation, to ensure that we can provide cover to our members who are carrying oil below the price cap. On reporting, on the EU and US side, records should be maintained for a minimum of 5 years from the date of transport. There is no general reporting requirement. That's a little bit different on the UK side. The UK, if you're a tier 1 person, so UK ship owners, and sorry, not UK ship owners, UK tier 1 persons have to report use of a general license to OFSI within 30 days. And if you are a UK ship owner and the tier 1 entity you are dealing with is subject to UK jurisdiction, then you must receive confirmation that that tier 1 UK person has reported to OFSI. Now, if the tier 1 entity is not subject to UK jurisdiction, you don't need to do that. So that was a really quick run through just some of the key comparative features of the UK, EU, and US provisions. I'm now going to hand it over to David, who's going to spend a couple of minutes just talking about the issue that we've been facing in Turkey.
Thank you, Mark. I can take this fairly quickly, although that's not to undermine its importance for ship owners and ship operators. And I'm going to talk about one of the consequences of the recent increase in sanctions and the oil price cap, and that is a request from the Turkish authorities for letters of confirmation of entry with P&I clubs. So the Turkish authorities had a concern that ships might transit Turkish waters or Turkish-controlled straits without the benefit of IG/P&I cover. And so on the 16th of November, they issued a notice requiring all ships transiting or entering their waters from the 1st of December, although that was extended, to provide a letter of confirmation from the ship's P&I club attesting that cover would remain in place under any circumstances throughout the duration of the transit, the time the ship was in Turkish waters, or any stay at a port or terminal. So, whilst it's not unusual for authorities to ask for confirmation of entry with a club, these new requirements from the Turkish authorities go beyond the typical requirements in this area, in that they require the club to confirm that cover won't be prejudiced at any time and in any situation. So that would include a situation where there is a breach of sanctions regimes, and as we've seen in the previous discussions, those have the effect of putting the ship off risk as a matter of law. And so the IG concluded that IG clubs couldn't comply with that request, and they've sought to resolve the issue by becoming involved in discussions with the Turkish authorities. One of the concerns being that even the provision of the letter itself, which guaranteed cover would remain in place in all circumstances, and even if the trade was sanctioned, the provision of that letter might itself violate EU, UK or US law. Nor does the request of the Turkish authorities seem necessary, since the EU, UK, US sanctions we've been talking about provide that cover will be provided in an emergency response situation. And so in some ways, the Turkish authorities are now in a better position in the event of a sanctions breach than they were previously. One of the responses from the Turkish authorities has been to ask clubs to satisfy themselves that the trade is lawful and then issue the letter. But even if that was practicable, it wouldn't overcome the problem that illegality might arise in the future. For example, if the cargo was sold whilst on the water above the price cap. And overall, this seems to us to be a political issue, which, whilst we can involve ourselves in the negotiations, IG clubs can't resolve by themselves. Those discussions are ongoing, and we understand that members are very keen to ensure their voyages continue through Turkish-controlled straits and waters, and want confirmation of entry, and we hope to see a resolution soon. We have heard reports of some owners experiencing delays in getting clearance through Turkish waters, but it's not reported that any yet have been refused passage. So with that, I will hand back to Mark.
Thanks, David, and thank you all for the questions that have been coming through during the session. And also, as I say, thanks also to those who submitted their questions in advance, and apologies if we don't get to them all. We'll do our best to deal with as many as possible in the next 20 minutes or so. First one, Mike, if I can maybe turn to you. One of the questions we've been asked is about the revision of the price cap. How often will it be revised?
Yes, I believe there's a price cap committee. I think the first revision date from memory, I didn't get a chance to check, is going to be the 1st of January. That doesn't mean to say that it will be revised at that particular date, but it does mean that the committee will sit down and review whether it's still appropriate. Within the EU legislation, but not the US or the UK, there's a commitment to, I think, keep it the price cap 5% below the market price for crude and petroleum products. So clearly, if there's you start to see a large differential between the two, then you could expect the price cap to be amended again. I think one of the reasons why the European Union was so late in getting their legislation in place, and it really only happened over the weekend, was because of differences of opinion between the various member states of the European Union as to what the price cap should be, with certain, a number of states, particularly in the Baltic regions, arguing for a much lower price. Personally, I don't expect it to go up. I do expect it to come down. There are provisions, I think 90-day provisions, to allow vessels that have loaded at the old price cap to get rid of their cargo when the price has been changed again. So probably fixed now until the new year, but after the new year, quite likely that it'll be changed again.
Thanks, Mike. And a question that we've had about the notice that the club will require from owners that they'll fix the vessel for the carriage of Russian oil, and whether there's a specific wording for the attestation to the club. I suppose the first point here is that most of you will probably be aware that under the SPIRE requirements that have been in place for since last March, we do require details of Russian voyages within 30 days, which is that requirement still exists post the price cap. So we will need details of Russian voyages in the normal way, and we will also require an attestation. Mike, I don't know whether you want to comment on exactly what that might look like and how we're going to try and deal with the attestation requirement.
Yes, we recognise that we might need to obtain an attestation. The wording of the 3 sets of guidance has been a little confusing in this respect. Some suggest that existing policy exclusions will be sufficient. Others, particularly the UK, suggest maybe that a little bit more may be required. The group is in the process of taking advice as to the nature of an attestation that it will require from its members. I think the first thing you will see is we're working now on finalising a circular which will go out to members, and it will be made very clear in a circular which does have effect in the contractual relationship between member and club, that we will only cover cargoes which are traded below price cap, but we will possibly, the current thinking is also require ship owners who are intending to carry such cargoes to complete a form of attestation which will be annexed to the circular when it goes out. That's our current thinking, and it may be that then forms part of the annual renewal documentation, but we're still in the process of taking advice. That's just an indication of the thinking that we currently have.
Thanks, Mike. And I suppose for ship owners as well, if you're entering into charter parties now which permit the carriage of Russian oil, I'm sure we're going to start seeing, and no doubt we'll be looking at them as well, we're going to start seeing charter party clauses requiring the charterer to confirm and attest that any Russian oil being carried will be done so under the price cap. David, I'm going to ask you a question, which is, I think, a bit of a probably a difficult one to answer, but I'm going to give it a go anyway, which is that it seems that currently over 20 vessels experiencing delays in obtaining clearance for their Turkish Straits transit. How long do you expect to find a solution with the Turkish authorities? I guess everybody understands the urgency, and we're trying to do what we can.
Absolutely. I think that there is a lot of engagement on this. It's quite a new issue, and I said earlier, largely a political one, which the IG by itself won't be able to resolve. We know that the UK and the US governments are continuing to engage with the Turkish authorities heavily, and the IG clubs are prepared to do whatever is required to provide assurances that they are going to cover claims where it's lawful to do so, and to point out the emergency response exception. So as more and more ships experience delays, I imagine the pressure will increase, and that may lead to a solution.
Thanks, David. One of the other questions, and I know this is something which has caused us to scratch our heads a little bit on the UK side, is the reference that pops up to customary due diligence and what that might actually mean for both a ship owner and a P&I club. Mike, I don't know whether you've got any thoughts on that question, which has been raised, as to whether we can provide more context and examples of what customary due diligence might look like.
Yes, it's a difficult one, this, isn't it? Because the expectations of states are really governed by previous sanctions regimes. So the history of this, I think, as I referenced, was that the United States, in their initial draft guidance, suggested that ship owners, insurers should be looking at their May 2020 advisory, which made significant reference to AIS tracking and this sort of thing. And we objected to that quite strongly, saying that's simply not appropriate in this particular sanctions program. And you will see that in the final guidance, they've largely removed it, and they've simply said appropriate due diligence is required. And by that, I think they mean you should be checking the parties. Are you lifting the cargo from a business that is well established, and is there anything untoward about the actual transaction which it would cause you to raise suspicion? Unfortunately, the EU in particular we didn't have such an extensive dialogue with the European Union, and they've largely adopted some of the other measures that were referenced by the United States back in September, which we objected to. So if you look, I think I was just looking at it a moment ago, it's FAQ 47. They're talking here about best practices include establishing the automatic identification system, best practices and contractual requirements, monitoring ships throughout their entire transactions life cycle. These simply aren't appropriate for this particular sanctions program. Things like know your customers certainly are, and I think the best we're going to be able to afford at this stage is that you exercise common sense, and bear in mind that if you have concerns about a particular trade and you choose to continue, then you will probably not be viewed well in any subsequent investigation as to whether sanctions have been broken. So that's probably the best advice we can give at the moment. It's been an issue that's concerned us really from the off as to what states expect ship owners and clubs to do in these circumstances to verify the price of a cargo.
Thanks, Mike. We did have a question in advance, which I think requires us to get our crystal balls out, and more of a general post-price cap question, which was any views on what we should expect and the direction of travel for Russian sanctions within 2023. I don't know whether both of you would like to have a go at this one.
Well, I'll go first. I think, well, first of all, I think when you're looking at the Russian sanctions program, do not underestimate the political intent, the political imperative that this succeeds. I mean, this is the most wide-ranging sanctions program ever, and it's a dynamic sanctions program, so it is evolving. And some of the regulators and governments that we've discussed with describe it a little bit like the game of whack-a-mole. So you introduce a sanctions program, such as the price cap, you see where the breaches occur, and then you get your whack-a-mole and try and knock them down. So I think what you will see is this is the first attempt at the price cap. It will be reviewed very quickly, I suspect, certainly in the new year, to see how it's working. And if there's any obvious breaches, then states, EU G7 coalition will legislate to knock those down. The United States has said in response to direct questions that secondary sanctions are not off the table. And I think if we find widespread carriage of cargoes above price cap from non-EU G7 nations, then they may well resort to secondary sanctions to try and restrict that particular trade. So it's not going to get any easier, I think, really, until the war comes to an end, would be my view. And the price cap scheme is likely to be tightened over the course of the next few months. David, I don't know if you have any additional thoughts on that.
Yeah, I think based on what I've read, so that these sanctions programs have been in place now for a little while, and so there's been some analysis of what is effective and what isn't effective. And it seems that in the long term, the more effective sanctions are those that prevent the import of critical infrastructure components into Russia, because over time it weakens their economy, their ability to repair industrial facilities, things like that. So if I had to do some crystal ball gazing for where sanctions are going generally, I would say probably more import sanctions on what can be taken into Russia and more enforcement there, but with the current focus at the moment being really on energy.
Yeah, thanks both. Just going back to the Turkish issue, one of the questions that's been raised is that why the clubs cannot provide some letter of attestation to the Turkish authorities when the vessels, or most of the vessels that are waiting, are not actually carrying Russian oil. David or Mike, I don't know if either of you want to.
I'm happy to have a first go. Happy to also hear what Mike has anything to add. I think that there should be no issue with confirming that a ship is entered with an IG club. That's very easily done. You can check the IG's website. It's updated every 24 hours. And you can check the club's individual website. So seeing that a ship has cover is very easy, and that there have been discussions in the past with the Turkish authorities where they've agreed to that in 2011, for example, plus certificates of entry. So that this issue does come up from time to time. What's different and more difficult here is the idea of guaranteeing cover will not be prejudiced, and that is very difficult, whatever the ship is carrying.
Yeah, I'd absolutely agree with that. I think the unique factor here is that it's not that we haven't been trying to find a solution to this. If it was simply a case of issuing the old paper confirmations of entry to a ship owner who could then pass it on to the Turkish authorities, we'd have probably sorted it out quite some time ago. The simple fact is that that is not acceptable to the Turks, and that's been made very clear to us. And the position is, as David's just said, that they need some level of comfort that, or they're holding out for some level of comfort that cover will be available even where a vessel is breaking sanctions. And that's really very difficult because the whole basis of modern sanctions targeting shipping and shipping services is that those services are withdrawn, and parties who don't withdraw those services face criminal prosecution where sanctions are being broken. So I personally, I think the Turks have reasonably got everything they could expect. It's very easy to see whether a vessel is on risk. You simply check the IG website. That's been a satisfactory means of confirming entry for some time now. And in relation to this current sanctions program, the widespread exceptions for dealing with emergencies and threats to life mean that they should have comfort even where a vessel is transiting the Bosphorus and cover is withdrawn mid-passage. So it's really quite difficult to understand what more they can ask for or can reasonably expect in these circumstances. And frankly, I don't really think it's not a club Turkey discussion, and hasn't been for some time. It's something that the US and the UK are working very hard on to try and resolve. And the solution to this, unfortunately, will be a political one rather than a piece of paper from an international group P&I club.
Great, thanks, Mike. I'm conscious we're coming up to our allotted time. One question that we did have in advance was another more general one about the, I suppose what we haven't really talked about is the Russian response to the price cap and how we think the price cap will affect the market and whether oil will continue to flow below price cap from Russia in the coming months. Mike, I don't know whether you want to comment on.
Yes,
on this one.
I think it's an interesting question, isn't it? Publicly, certainly Russia can do nothing but say it will not sell cargoes to people who are part of the price cap scheme. And at the moment, that is just the EU, G7 plus Australia. But the price is set quite high, and the majority of Russian cargoes currently would be below price cap in any event. So there is compliance in practice, if not in name. And anecdotally, speaking to charterers and other parties, they have heard from their Russian counterparts that they will almost certainly continue to try and trade their cargoes below price cap if necessary, simply because they can continue to make money out of it. I think the production costs of Russian oil is somewhere around about late teens, early $20 per barrel. So provided the price is above that, there is an incentive for Russia to continue to sell its oil. So there will be no public acceptance of the Russian oil price cap, and there will certainly be attempts to try and undermine the scheme. That may be, I'm not suggesting it is, but that may be what's going on in Turkey. But in practice, I think certainly whilst the price is set so high, the majority of cargoes will be compliant. That may change when the price cap reduces.
Great, thanks, Mike. And thank you all for asking so many interesting questions. Apologies that I'm conscious there's probably a few that we haven't had a time to get to this afternoon. Mike, myself, and David would be more than happy to answer any questions offline after this session. And our sanctions advice team is always happy to help with any queries that people have. I think probably just in conclusion, we should just say, look, this is all new. We're trying to work our way through it. We understand some of the challenges. There will be a IG circular coming out soon, which will have more details of the price cap, and there'll be more details of the attestations that's required for those vessels, which for those owners which are carrying oil below the price cap going forward. So I think all it leaves for me to say is thanks again for joining. We appreciate you all taking the time, and we look forward to seeing you on another sanctions webinar, hopefully not too soon, because that would mean that there's more sanctions that have come in, but in due course we look forward to seeing you on another one of these webinars. Good afternoon.
Thank you very much. Bye.